Good morning everyone. Welcome to Oliveboard. So today again we are going to start our module C MCQs Treasury Management. We will see all the MCQs and all the related concepts to these MCQs which helps you in brushing up your concepts. So let's get started with today's session, and here I am hoping that I am visible, I am audible, my screen is also visible to you. So for first question is here, what are the two reserve requirements that treasury has to comply with? What are these two reserve requirements that treasury has to comply with? Now for this, let's understand what is the meaning of first MCLR. We know that this stands for marginal cost of funds, which is based lending rate. Now that means, what does that means? In the minimum interest rate that a bank can lend at. And also it is determined based on the bank's cost of funds, the operating cost, the tenor premium. And this is also replaced the base rate system in the India, and serves to better align lending rates with the bank's cost of borrowing. Then again, what is the meaning of here repo? That is repurchase rate. What is that means? The repo rate. The repo rate is that rate at which the central bank, like Reserve Bank of India, lends money to the commercial banks, typically for the short-term needs, and also when the central bank raises the repo rate, borrowing becomes more expensive, which helps control inflation. So we can say here two reserve requirements are there. Is a CRR is there and SLR is there. CRR basically, and value at risk is there. CRR, cash reserve ratio. This is the percentage of a bank's total deposits that must be maintained with the central bank, that is RBI in India. And SLR is a statutory liquidity ratio. This is the percentage of a bank's net demand and time liabilities that must be maintained in the form of liquid assets such as gold, cash, or government approved securities. And if we talk about the two reserve requirements that treasury has to treasury has to comply with. So the two key reserve requirement which is used to control liquidity in the economy and ensure the financial health of banks are CRR and SLR. Cash reserve ratio, statutory liquidity ratio. Okay. Why, Sureen sir? The answer is here CRR and SLR, not A, MCLR and SLR. The answer is cash reserve ratio and statutory liquidity ratio, because these are those key reserve requirements which are used to control the liquidity in the economy. And also they are helping in ensuring the financial health of the banks. Now, integrated treasury. Integrated treasury in banking. What is the meaning of integrated treasury in the banking? We know that integrated treasury in banking means like consolidation. Consolidation and also integration of various treasury operations, which also includes the money market, securities market, and also FX market, that is forex market. But these all are under one roof. Okay. Now this also allows the bank to effectively manage the liquidity risks and also the investments across the different markets, enabling the better coordination and the optimization of the resources. And here the goal of integrated treasury management is to improve the efficiency, minimizing the cost, reducing the risk by having a centralized approach to handling multiple asset classes and the market operations. So we can say that here the correct answer is option D, which is integration of money market, securities market and foreign exchange operations. Okay. Third question is there. You have to tell the important operational feature of integrated treasury. Yes. Great, Surinsa. Second option D correct. Second question D option is correct. Now time for the third question. What is the important operational feature of integrated treasury? Having a common dealing room. See, let's see the answer. Yeah. See, if we talk about the correct answer in this, having a common dealing room, having a mid-back offices, and also looking for interest arbitrage across currency markets or in a position to shift swiftly, a placement in the rupee denominated commercial bank. See, in this we will consider third option, second option and first option. Why? Like if we talk about the integrated treasury in the banking, it involves multiple operation features that also enhances the effectiveness and the efficiency. And why all the options are important here? Because having a common dealing room in the integrated treasury, having a common dealing room allows dealers and the traders from the different markets like money market, forex market and the securities market to work together in a single space, and they then this basically ensures better communication, coordination and also real time decision making across different financial markets. Also it improves the bank's ability to respond in the market changes quickly. And also if we having a common and mid back offices, so having a common and mid back offices, basically common mid office, that is risk monitoring and setting the market risk analysis, and the back office, which means settlement, reconciliation and reporting operations, which ensures the efficiency in handling the administration task and mitigate the risk across different types of markets. This type of centralization reduces the duplication of efforts and ensures compliance and operational consistency across treasury functions. And if we talk about the third option, in this is the one of the key feature of an integrated treasury, that interest rate arbitrage, which involves taking advantage of interest rate differentials between market, that is domestic market, and international market. And for example, here we can take that, like an integrated treasury can shift swiftly investments from rupee denominated commercials to US dollars in the global interbank. It identifies the better returns. It can also sources the funds globally and swap them into the domestic currency, or vice versa we can say, which depends on the market conditions and the opportunities. In summary, we can say that an integrated treasury basically relies on the combination of having a common dealing room and the ability to swiftly move funds across markets to capture the arbitrage opportunities. So we can say here all of the above options are correct, which basically allows here uh, integrated treasuries to function efficiently and the profitably. Okay, third D correct. Next, treasury in the normal course will manage all funds raised through deposits, all deployments of funds through advances, liquidity, ALM book, merchant book, and trading book. Great. See, ALM book, that is asset liability management book. This involves the bank's balance sheet, ensuring that assets and liabilities are structured in a way that a balance risk and return while managing a liquidity and interest rate risk. Then this merchant book, this refers to the treasury role in handling the foreign exchange and the money market transactions for the bank's customers, particularly which is related to the trade finance, forex services, and other corporate needs. And trading book, this refers to the including the assets which is basically held by the bank that are subjected to the short term trading, and it consists a lot of instruments like securities, derivatives, forex positions, and other financial assets which are bought or sold for trading purposes. And this treasury basically manages these positions to take advantage of market movements. So we can say here option D is correct here. Okay. Now globalization. Globalization refers to what is the correct answer? Globalization is that the process of basically integrating the economies, financial markets, trades, investments across the countries, which leads to increasing the interaction and interdependencies among the nations. It involves the free capital flows between countries, open trade policies, reduced the regulatory interventions which allow more seamless movements of goods, services, and capital. Globalization also fosters interconnectedness and encourage economic integration of a global level. So we can say here the correct answer is the process of integrating domestic market with global market, which is characterized by the free capital flows and minimum regulatory intervention. So the option D is correct here. Great, Sureen sir. Now all the exchange rates quoted on the screen or in print are of dash unless otherwise mentioned. Four transactions are given here: forward transactions, cash transactions, spot transactions, and the term transactions. Forward transactions are those transactions which involves agreeingness, agreeing on an exchange rate today for a current currency transaction that will take place at a future date, typically beyond 2 days, 2 business days. This rate are not the standard rates quoted unless these are stated. Cash transactions refers to the same day settlement of a foreign exchange transaction. These rates are usually different from spot rates and need to be explicitly mentioned. And this term, which is basically tomorrow transactions, which is settled on the next business day and the transaction date. These rates are not standard and will not be mentioned separately if applicable. And what about the spot transaction? Spot transactions are those transactions which is refers to the foreign exchange transactions where the exchange of currencies occurs immediately or typically within 2 business days after the trade date. When you see the exchange rates which is quoted on the financial screens or in the print, they are usually for the spot transaction unless otherwise specified. So we can say here the answer is option C, that is spot transactions. Now forward rates fully reflect interest rate differentials only in forward exchange rates reflects the interest rate differentials only between two currencies, which is based on the principle of the covered interest rates policy, that is CAIIB. Now basically we can say in these types of condition, forward rate should fully reflect the interest rate differential between the two countries. At the market, participants will arbitrate away any type of disparity. So we can say that the correct answer is here: in perfect market where the currencies are fully convertible and markets are highly liquid, because there is sufficient volume and activity in the market which allows transactions to occur easily without significant price distortions. And currency are fully convertible because there are no restrictions on the buying and selling of currency in the foreign exchange market. And perfect market, basically we can say in such markets there are no transaction cost, taxes and other frictions that can affect the pricing. Option D is correct here. What is the meaning of nostro account here? Correct. Nostro account. See, nostro accounts are those accounts that a bank holds in a foreign currency in another bank. Okay. Nostro accounts are those accounts that a bank holds in a foreign currency but in another bank outside its home country. These accounts basically facilitate the international transactions and foreign exchange dealings, which allows banks to manage their foreign currency liquidity more effectively. Example: If an Indian bank has an account in US dollar with a US bank, that account is referred as an nostro account. So here, nostro accounts are basically current account which is denominated in the foreign currency and maintained by the banks with their correspondence banks. Notice money refers to Notice money refers to the funds which is placed in the money market for a short period, specifically for a duration between 1 to 14 days. It means for the bank to manage their short-term liquidity needs, which allows them to borrow or lend money for very short period. And overnight placed fund is not a correct answer here. Fund placed after a notice of placement is not a correct answer here. So the D option is correct according to the definitions, according to the meaning. D option is correct here. Correct, Sureen sir, very good. You're doing good. Sureen sir, very good. You're doing good. Now, moving to the next one. The salient feature of a convertible bond is, what is the salient feature here of the convertible bond? Four options are given. Convertible bond, we know that it is a type of bond that basically gives the bond holder the right. That gives bond holder the right but not the obligation to convert the bond into specified number of shares and issuing company stock at a predetermined price with a specified time frame. This feature also allows investors to benefit from the potential appreciation in the company's equity value while also receiving fixed interest rate until conversion. So here the correct answer is, the salient feature is the option to convert the bond into equity on a fixed date during a fixed period and the price is predetermined. D option is correct here. GDRs represent what? GDRs represent basically. GDRs represent here see, if we talk about the GDRs basically the global depository receipts. These are the financial instruments which is used by the company to raise the capital in the foreign market. Okay, they are issued by a depository bank overseas and represent a specific manner of shares in an Indian company. Each GDR corresponds to a certain number of shares of the underlying stock, which can be traded on international market. This mechanism also allows foreign investors to buy the shares in the Indian companies without having to directly purchase the shares on the Indian exchanges. So GDR here representing the negotiable receipts which is issued by the overseas depository representing the prefixed number of equity shares of an Indian equity. Option C is correct here. Okay. IDRs are denominated by Indian depository receipts. Basically, what does means? This means these are also the financial instruments. IDRs are the financial instruments that basically allows the foreign companies to raise the capital in India by issuing the receipts against their equity shares. These IDRs are denominated in the INR, meaning that they are traded and settled in the Indian currency. So, we can say IDR are denominated in Indian rupee. Understood? ECBs can be raised. ECBs, external commercial borrowings. External commercial borrowings. These refers to the loans which are raised by the Indian entities from the foreign lenders in foreign currency or in an Indian rupees. These loans can be raised in any freely convertible currency, which allows Indian companies to tap into a broader pool of international financial options. This includes major currencies like the US dollar, euro, and the other as well as Indian rupee. So ECB can be raised in any free convertible currency. Great, Sureen sir. Which of the following is not true in respect of trade credits? What is the meaning of trade credits? What trade credits basically called? If we talk about here, the trade credits. So basically, in this, domestic banks cannot guarantee the repayment of trade credits, because domestic banks can provide guarantee for the trade credits. They may issue guarantee to foreign suppliers, ensuring them of repayment, which helps in facilitating the international trade. And if we talk about here, what is the meaning of trade credit? Trade credit is basically this is a financing arrangement. This is a financing arrangement between the businesses that allows a customer to buy good or services from a supplier without paying immediately. Basically, we can say this is an agreement between two parties, that is a customer to purchase the things, one, and other party is supplier. Okay, so which one is not true here? Domestic banks cannot guarantee the repayment of trade credits. This is not true, because these are providing the guarantee for the trade credits. They may issue the guarantees for trade to the foreign suppliers, which assuring them of repayment, which helps facilitating the international trade. Okay. Yeah, 14th A answer is correct. The components of broad money M3 are. The components of broad money M3 are. If we talk about the components of M3, this is the measure of total money supply in an economy, which includes several components. First one is currency in circulation. This refers to the physical cash, notes and the coins in the hands of the public and the businesses, which exclude the cash which is held by the banks. Then demand deposit with the banks. These are the deposits that can be withdrawn on demand without any notice, such as checking the accounts. Then time deposit with banks. These are the deposits held at bank for a fixed period of time, where the depositor typically cannot withdraw the funds without penalty until the maturity date. And post office saving deposits, these are the savings account which is held by the post office, which are also considered part of the money supply. So in the components of broad money, these things are included. So option D is correct here. Now the exemptions from the DTL include, the exemptions from the DTL include, DTL is depository target level. This is the regulatory measure that affects the liquidity and the availability of the funds for the banks and the financial institutions. And certain transactions for these deposits may be exempt from the DTL to encourage the specific type of financial activities. Okay. And generally we can say the transaction in tri-party repo GSEC with CCIL is exempted because it involves the government securities, and these are exempt from the DTL as they are considered as secured and short-term borrowings arrangements, which are important for the liquidity management. So here option C is correct, which is exempted from the DTL. The liquidity corridor the RBI used to control short-term interest rate is defined by, yes, 16. Correct answer is C. Very good, Sureen sir. The liquidity corridor that RBI uses to control short-term interest rate is defined and dictated by, see, the liquidity control corridor, basically the liquidity corridor that the RBI uses to control the short-term interest rates is basically defined by the MSF. MSF is marginal standing facility, and the SDF. SDF is standing deposit facility. Marginal standing facility is the rate at which the banks can be borrow overnight funds from the RBI by pledging government securities. It serves as the upper limit of the liquidity corridor. Then SDF is the rate at which banks can park their excess funds with the RBI overnight without any collateral, and it acts as the lower limit of the liquidity corridor. So we can say that option A is correct here. Now RTGS has been fully activated by the RBI. RTGS is real-time gross settlement, which is fully activated by RBI in October 2004. This means that transactions are settled in the gross basis, meaning each transaction is settled individually and not in batches. And this is a system for transferring the money and securities in real time on a gross basis. It is primarily used for a high value transaction and is a crucial component of the financial infrastructure in many countries, which also include the India. And this is the essential payment system that allows for the real gross settlement of high value transaction and ensures the efficiency, security and the convenience in the fund transfers. So here we can say the correct answer is RTGS has been fully activated by the RBI from October 2004 and where the settlement are on gross basis rather than end net settlement of checks in clearing house. Option B is correct here. Next question. See, the following institution facilitate delivery versus payment, that is DVP. This is delivery versus payment. It is a settlement mechanism which is used by the financial markets, and in this it is ensuring that the transfer of securities, which is equity and the debt paper, which occurs simultaneously with the transfer of funds. This also minimizes the risk of default by the either party, and these are basically done by the NSDL and CSDL. NSDL is one of the two depository in India that holds the securities in the smooth settlement of securities transaction. NSDL is basically National Securities Depository Limited, and CSDL is Central Securities Depository Limited, is the other depository in the India that also plays an important role in the settlement of securities and also facilitate the DVF transactions. So these C option is correct here. Now, for ensuring effective risk control, RBI expects here to facilitate the functional segregation between, yes, very good Sareen sir, correct answer you are giving. For ensuring the effective risk control, RBI expects banks to facilitate functional segregation between, see, for effective risk control, the RBI emphasizes the need for functional segregation with banks, particularly among the following. First one is front office. Front office, this includes the department which are responsible for the direct interactions with the clients and executing trades. And these includes the sales, trading, investments, banking activities. Then the mid office, this segment is responsible for the risk management and the compliance. It monitors the activities of the front office, assesses the risk and ensures the adherence to regulations and the internal policies. And back office is basically this part handles the administration and support the functions including the settlement, clearing and the record keeping. It ensures that all transactions are processed accurately and efficiently. So here we can mark option D is correct. Now the most important and well pronounced risk in treasury risk is, most important and pronounced risk in treasury, market risk. Why? Because market risk is the risk in which losses in the financial instrument due to the fluctuation of market prices, interest rate and the exchange rate. And treasuries deals with the variety of financial instruments which includes bonds, stocks, currencies and derivatives. And changing in the market condition can significantly impact the value of these transactions, these instruments. So that's why in treasury, market risk is the most important and pronounced risk. Okay. Then next question. The following limits in treasury are meant for controlling market risk? Great. Very good, sir. The following limits in treasury are meant for controlling market risk. In treasury operation, various limits are established to control the market risk, which arises from the fluctuations in the market prices, interest rate, foreign exchange rate, and here how the different things are here there, but the correct answer is there: intraday, overnight, open position limit, and stop loss limit. What is the meaning of this intraday and overnight open position limits? Basically, these limits defines the maximum amount of exposure a treasury can hold at any given time, both during the trading day and the overnight. They can manage the risk associated with holding positions in the volatile market. And stop loss limits, basically these are the predefined levels of the positions that will be excited to prevent the future losses, yeah, or further losses, we can say. These are crucial for controlling the potential losses in a volatile market that are directly related to managing the market risk. So here we can say option C is correct here. 21, option C. Great. Now, value at risk is a statistical measure which is useful to capture. Value at risk is a statistical measure which we know that, and it is useful for quantify the of loss, risk of loss or portfolio of assets on a portfolio of assets. It provides an estimate of the maximum potential loss over a specified time period with a certain level of confidence, and we can say here the correct answer is probable loss in a portfolio with a time horizon at a given confidence level, because we know that value at risk is calculated for a specific time frame. This time horizon is critical for understanding the risk over that period. Now, yield and price of a bond move. This is in the inverse proportion. Why? Because the relationship between the yield and price of a bond is characterized by an inverse proportion. And when the price of the bond increases, yield decreases, and the vice versa. And yield is calculated based on the bond's coupon value, which is related to the its current market price. Okay. The value of a derivative is determined by the value of a derivative is determined by basically it is determined by the value of a underlying, means the value of a derivative is fundamentally linked to the value of an underlying asset. Underlying assets, derivatives are the financial instruments we know whose value is derived from the performance of an underlying assets. These underlying can be stock, bonds, commodities, interest rates, and the currencies. For example, the value of a stock option is determined by the price of the underlying stock. So that's why A option is correct here. Very good, Sureen sir. Now tell me the one essential difference between OTC, over the counter, and the exchange traded derivatives. Over the counter and exchange rate derivatives. We know that over the counters derivatives are the privately negotiated and traded directly between two parties without going through an exchange. This leads to the significant counterparty risk, which is the risk that one party may default in its contractual obligations. And this exchange trade derivatives, these are basically standardized contracts that are traded on the regulated exchanges. So we can say here in the OTC derivatives, counterparty risk is prominent, but in exchange traded derivatives, counterparty risk is totally absent. So option C is correct here. Now in case of free currencies, forward premium or discount is exactly equal to the difference between what is the difference between, see, in the context of we talk about free floating currencies, the forward premium or the discount is the difference between the interest rates between the two uh, currencies which is involved in the currency pair. And forward premium, we know that when it is occur when a forward rate exchange of a currency is higher than the spot exchange rates. So here we can say that option A is correct, risk free interest rate of the two currencies. Great, very good, Sureen sir. Now a put option in the money IATM is, put option in the money ITM is, what is ITM? ITM is the in the money is and also a put option gives the holder the right but not the obligation to sell an underlying asset at a specified strike price before or at expiration. A put option is considered in the money when the strike price is greater than the current market price of an underlying asset. This also this situation means the holder can sell the assets for more than its current market value, which would lend to a profit if exercised. So the strike price is here more than the market price. Option B is correct here. And next, in India, market for currency future commenced in August 1993. No, I think in August 2008. Yes, the market for the currency future in India, it is officially commenced in August 2008. Yeah, when the National Commodity and Derivative Exchange NDEX launched this currency futures trading. So correct answer is August 2008. Sorry for the mistake. I am confused between the years, but the correct answer is August 2008. Liquidity risk is reflected as which is the gap in, there is also question fill blank is there. Liquidity risk is reflected as dash, which is the gap in, we know that what is liquidity risk, it is the risk that may when the entity is not able to meet its financial obligations as they come due without incurring significant losses. And maturity mismatches, this occurs when there is a difference between the maturity profiles of assets and liabilities. So we can say that the correct answer is here option A, that is maturity mismatch and cash inflow and outflow. So it is reflected. Correct answer. Very good, Sureen sir. Then next question, derivatives can be used here to hedge the aggregate risk as reflected in the asset liability mismatches. This case, a dynamic management of hedge is necessarily because see, derivatives are often used hedge against the risk that arises from the mismatches, and these mismatches in the asset liability structure of an organization. It also includes changing the composition of assets and liabilities. And here we can say that derivatives are can be used here basically when the composition of assets and liabilities are always changing. Option C is correct here. Because as these changes occur, effectiveness of the existing hedge can diminish, which necessitates the adjustments of the hedging strategies to ensure the continued protection against the risk. Great. Then the participants in the derivative market generally exchange the following agreement. I think ISDA is International Swaps and Derivatives Association, and this is basically is a key player in the derivative market, which provides the standard documentation and also the agreements in the market. This agreement outlines the terms and conditions which derivative trades will be conducted, facilitate the better risk management and legal clarities between the parties. Okay, so C option is correct. And the last question for the day is, credit derivatives segregate dash from the assets through instruments which is known as the dash transfer the risk from the owner to other person who is in the position to observe the credit risk for dash. We know that credit derivatives are the financial instruments which are used to manage and transfers the credit risk which is associated with the various types of assets. And we know that what is the meaning of credit risk. Credit risk in which credit derivatives are designed to segregate this credit risk from the underlying assets. This means the risk of default associated with the assets that can be separated from the asset itself. Now this CDS, this is one of the most common term, credit default swap. This is basically a agreement. CDS basically is a agreement here between the two parties where one party pays a premium or fee, we can say, to the another party for a protection against the default of a borrower or the bond issuer. And income warrants consideration, this is not the correct option because this is not related to the core function of the credit derivatives. So, and good asset securitization discount is also not a correct answer of credit, and it is not related to the credit risk management. So the correct answer is option B, the credit risk, credit default swap and also the fee. 32 answer B is correct. So this is the module C we have done today, and all the important questions of here of Macmillan is completed. Thank you so much for attending this session. We will also do module D. uh, all the MCQs we will cover. We will do the session on this also. So thank you so much for today attending this class. I hope you enjoyed the session. If you enjoyed the session, kindly give the like to this video and also do the comment and subscribe to this channel. We will meet in our next session. Till then, take care, keep practicing and be happy. Have a good day all. And thank you.